Welcome to Finance This, Property That. My name's Dion Fernandez, and this podcast is for property enthusiasts, time-poor professionals, self-employed borrowers, and strategic investors looking for residential or commercial property who want more than just a low interest rate. They want a strategy and a team around them. Each week, I'll share strategies, structures, and lending moves that actually grow wealth, not just get you the loan. And also, I will help you surround yourself with information from professionals in their field. If you're here to build smart, not slow, you're in the right place. My vision is to empower financial legacies for generations. I am a mortgage planner and finance strategist, and I work with doctors, developers, business owners, and high-income earners to build serious property portfolios. So without further ado, let's get into today's episode. Hey everybody, welcome to this episode of Finance This, Property That. Like to just share with you another couple of key talking points that my clients have been bringing up. And today we're going to talk about why the lowest rate, or why trying to get the lowest rate can cost you more in the long run. So key talking points is, what is this obsession with rate? Couple of things that lenders or brokers won't tell you, and I'll go through the way I sort of approach it. Cool. So where does this obsession with rate come from? And it's kind of misleading. So COVID, we saw some really, really low rates, right? And we all got a bit customized to it. These are just my beliefs. We got a bit customized to it, but you know, the rates where they're sitting at the moment are pretty bang on where they should be sitting, based on the strength of the economy and also historical data. What we saw in COVID is not sustainable, and it was a cause and effect of something external that we couldn't control. So since we've got used to it, we're just all really price and rate sensitive. However, if you're trying to build a portfolio, rate can't be your number one thing. Policy has to drive the lender we go to. Policy, valuation, and then it will come down to rate. Because you can't get the cheapest rate if you don't meet the lender policy, and you can't grow if you're just chasing the cheapest rate and you're just going to a lender that doesn't meet the requirements of you trying to grow. Sure, we can get back to those cheaper lenders and cheaper products, etc. down the track. But if you're trying to grow, forget about trying to figure out what the best rate is. We need to figure out what the best policy is and best valuations, and then grow it that way, because we can always circle back. So what are some of the things that the brokers or banks won't tell you? Or not so much brokers, more the banks. So usually when you see these really cool honeymoon rates or these basic rates, they are lower rates because they have less running costs on them. Usually there'll be no offsets. Most cases there'll be redraw, but they could be charging you for redraw. Also, if you go and chase like the cheap products and cheap rates, that bank probably will have worse policy. Like, they won't have the policy that you actually need, right? So like I said before, you know, your valuations matter, your servicing matters, your policy matters, and also your structure matters, right? That's what a lot of lenders and some brokers won't tell you. That, you know, we don't want to. They matter more. We don't want to get the deal done. We want to grow things for you. So the way I approach it, really easy. I look at making sure the loan works for you, not just for the next deal, but for the next 2 to 3 deals. I don't want to do multiple applications when I don't need to. We get it done. We get the policy. We get a pretty good rate. Like, the rates are pretty good right now. And we get the valuation that's going to be sustainable for the next 2 to 3 purchases. The rate needs to be sustainable, like I said, not just a honeymoon rate, because it doesn't really help anyone. Then once the honeymoon's over, you usually find that rate goes higher. So I don't generally tend to choose basic products or honeymoon rates when it's not required. Most of my clients will require an offset facility, especially for their owner-occupied. But if you've got an owner-occupied property with a multiple offset facility, well, you have multiple offsets. You know, you have rent from property investment 1, investment property 2, you've got another offset facility, but that's all also offsetting your owner-occupied debt, which actually pays that off quicker. We can then recycle the equity in that, reduce the commitment down, and go again. So that strategy is absolutely key. Valuation, servicing, policy, structure absolutely matter more. But the other key thing that I know the team at Emerge Finance do, and we've got the lovely Anne who does this for us. We reprice your lending every 6 months. This is to ensure that your rate's still competitive in the market. If it's not, we'll let you know, and we'll have a conversation to see if anything in your situation or personal circumstances has changed, and do we need to pivot? Simple. We just don't react. We're not a reactive, we're proactive. So if this sounds a bit like you and you're not kind of sure about what's going on, why you're chasing rate, or how to build a portfolio without worrying too much about rate, come and have a chat with me. I'm very easy to find at Dion Finance Specialist on Instagram, Dion Fernandez on LinkedIn. This podcast's got its own website, financethispropertythat.com.au. And as always, the information on this podcast is very general in nature, doesn't take into consideration your personal circumstances. Again, come and have a chat with me and we can talk more about you and figure out a tailored plan that works for you. Until the next episode, I'll see you later.